Welcome back to another episode of Smart Money Moves Fresh Minds. I'm Wesley.
I'm Joe. We haven't been on in a long time or recorded one, so we're finally getting back after it, and we'll change it up a little bit today.
Yeah, Joe. Joe is busy studying, just passed his CFP, so congratulations to you, Joe.
Thanks, Wes. Appreciate it. It's good to have my life back.
Yeah.
After 4 months. So.
Yeah, definitely a big hurdle. Joe's still adjusting to a normal life with no studying, so we thought we'd sit down today and record an episode for you guys. We have a couple questions today. We're doing something different. I'm going to ask Joe a couple questions. He's going to answer. And on the next episode, we're going to switch it up and Joe's going to ask me some questions. So without further ado, we'll get started.
It's also more of like a Q&A. So whoever's listening to this and who has questions that come up, feel free to comment any questions below or reach out to us directly, and we'll hit those next on the next episode.
Yeah, we'd be happy to do a Q&A episode with some questions that you guys have. So drop them in the comments or reach out to us directly and we'd be happy to answer those questions. All right. So, Joe, first question. We work with clients. We see a lot of different styles that advisors have. So how often, communication is a big thing with clients. How often should someone's financial plan be reviewed or updated?
I honestly think that depends on the client. If there's a big hurdle that happens, big life event, say business owner sells his business, his whole life has changed. So you always go back to square one. So I think any major life event that happens, a spouse dies, the higher wage earner is now who control the finances is now no longer living. And the spouse who never really controlled the finances their whole life has changed. They lost a loved one and now they're the ones in control of their finances. You got to go back to square one to see, now, what are their goals and where they want to achieve? They might be similar to their partners or spouses, but, everyone's different. So I think maybe any major life event, you should go back and reevaluate the full financial plan. When I think it comes to reviewing, like you said, it's all come down to communication. So we put that on the client's time and establish it when we first meet. It might be twice a year or once a year. They might want to meet every 3 months. It just depends on the client. When you start that engagement, you start that, that long-term relationship. But any major life event that comes up, call in right away. The plan needs to be updated. We need to factor in other things. Sometimes we come up with a full financial plan and then a week before we present it, something happens. So then we got to rework it again. It just comes with its ebbs and flows. And so I think it just depends on the type of client that you're working with. So I wouldn't say there's a set in stone answer, but you try to establish that when you first meet with them.
Yeah. And I think in short, communication is really the key to that. Let the client guide the relationship, and as long as we meet their goals. But, at a minimum, we want to meet with clients at least once a year, keep everything on track. All right, awesome. So that said, we'll transition over to retirement planning. Definitely one of the key areas, if not one of the most important areas, especially when clients come over. That's what most people are thinking about. Speaking of retirement planning, Joe, how do you specifically factor in Social Security and timing decisions? And how does Social Security affect investment decisions and investment allocation?
I say you want to look at their lifestyle. It's a couple, husband and wife, who's the higher wage earner, if they have the cash flow, they got the money on the side, have the higher wage earner delay it as much as possible, the delay credit to age 70, or maybe, the one that didn't work that much or was the one that sacrificed and took care of the kids. Stuff comes up. You could take it as early as 62. I think it all depends on, situation and where they're at. They could have a lot of retirement assets that are liquid, illiquid. They could have pension income. I know pensions don't really exist, but they're still out there, especially with teachers, government employees, military. My father has a pension, so we had to plan around that. So I just think it depends on, what's their expenses look like in retirement. The big factor is you're no longer working. If you have a nest egg, it's a pension, and let's say your expenses are $5,000 per month and your pension covers that, you don't need to take out Social Security. I think it just comes with different strategies in place. You could be taking out Social Security to cover your lifestyle that you're currently living and not taking out any retirement assets because, the Social Security currently covers your life. That being said, sometimes people think they're not going to spend that much in retirement because now they're not doing as much. But in reality, you would kind of end up spending more in retirement. You now have the freedom to go on vacations, see your grandkids, buy that second home, find a place where you never lived before. Let's say a person from the Northeast, they wanted to have a second home in Florida or the Carolinas. They want to be a snowbird somewhere warm. What's that cost look like? So in reality, we try to run the analysis as much as possible. I think every client situation is different. Some people might take it as much early as 62. Some people might delay it at 70. Some people might wait and take it at 67. I just think it depends on the assets they have, the income they have, the cash flow they have set on the side. Some people might have just their pension, that they get once they retire from, a teacher, government employee, military. So we just got to work around it. And then we just trying to find the most tax efficient way going forward. And then we coordinate that with an account, with work with our CPAs that we work with. And, we try to come up with some estimate numbers, but then we have the CPA confirm those numbers and then we go from there. And just try to have a good plan in place for that.
Yeah. And that's a lot to unpack there, but the underlying, premise is that everyone's situation is different and Social Security means different things to someone. Are we looking at a client that has a lot of money in a pre-tax account? Do they have Social Security, pension, and a ton of, $500,000, $1 million in a pre-tax account? It all plays together. It all comes together. We look at investments, tax planning, estate planning. Is a retirement well funded through Social Security and a pension? How much is that person spending? And it all comes down to somebody's specific circumstances. And Joey definitely brought up some great points there on how people have different lifestyles, different life circumstances, and how they all come together. And at the end of the day,
I would also say just a misconception I've been seeing is, you have a spouse, say that her benefit was 1,000. And you have the higher wage earners, say he, for example, was 4,000. It's called the primary insurance amount. So for the spouse, they get the greater of. So a lot of the spouses think they're only eligible for their $1,000 benefit per month. Well, in reality, they get the greater of their benefit or one half of the higher wage earner. So, 4,000, a half of that's 2,000. She wouldn't get her $1,000 benefit. She would get a $2,000 benefit. And that's a common thing I've been having to teach to people is, say, hey, there's misconception there with what amount of Social Security you get, especially for the spouses.
Yeah, definitely. And something else that you mentioned, Joe, is that, we like to coordinate with CPAs, if not, referring our clients out to a CPA, a trusted CPA that we use, or working with their CPA that they already have. How has that relationship been like? How does it work with clients, especially we're around tax time now? How does that help the client? How is that beneficial? And, how we work at Black Diamond, not just CPAs, but we also do it with estate attorneys, insurance agents. But in particular here, how is the relationship with CPAs and clients? And what are the benefits from having all the professionals and the client on the same page?
I think the benefit is just, you just have a better plan, a financial plan in place. It sounds cliche, but you have people that try to do everything themselves. In reality, even me as a financial planner, I can't do everything myself. I have to rely on talking to other people, get some information that I'm not seeing day to day. You try to not step on the CPA's toes. You try to have a good relationship as much as possible. And, you stay in your lane. You try to ask questions, pick their brain, let them make the decision. But also, get some different talking points about what the client might want to see going forward. And again, say you have a new person that comes in and they've been doing their own taxes for 4 years, 5 years, in the past 10 years. When you bring them in, especially with here at Black Diamond, we bring a CPA in when it comes tax time, but also we can then look at past tax returns up to 3 years and say, hey, did they miss something? Did their, if they had a CPA, their former CPA miss something? We're not just here to just say, okay, we're going to run these, just file taxes. We plan out the long-term effects, what's the advantage now of paying tax now for slavery? Those conversations we have, especially, with younger people. Historically, we have low tax brackets. So, how do we plan for looking 10, 15 years down the line? What's a benefit strategy? But also, all talk on the same page, especially taxes. We all bring our clients in and send them down with the CPA that we work with, or, they have a CPA that we haven't worked with before and they reach out to us and we just kind of coordinate. Like I said, communication, you got to be on top of it, especially tax time. People want it done. And don't wait, don't drop the 8 ball. But I just think try and stay in your lane, don't step on each other's toes. I think that's the most common thing. When you have a great relationship in the CPA, they understand where you're coming from. At the end of the day, you have your client's best interest at heart.
Yeah. And I think too that, CPAs and us as financial planners, we wear similar hats, but at the end of the day, they're different hats. So we have a different perspective and it's a new set of eyes on someone's tax return, knowing their circumstances more perhaps than their CPA, and being able to say, hey, we should look at, XYZ retirement plan here. We should look at, retirement taxes. There's, different things that may come up, looking at it through a different lens than a CPA, even though we're looking at it through similar lenses. So awesome. All right, guys. Well, thank you for tuning in. It's been a great episode. We'll see you guys next week.